Hi everyone and welcome to this new video. I'm sorry that it took a lot to make a new one, but sometimes life kicks in and you have to answer. So today we're going to talk about how to support and resistance areas. So first of all, I would like to try to explain what is support and what is resistance, just to set some foundations and very quickly go through the idea. Basically, support is every area of price where you're going to find people buying the stock or the commodity or whatever it is at that price. This can be identified in several ways. We're going through them. And similarly, the same concept we can apply to resistance. So where people are most likely going to sell. Okay? Support and resistance are two things that can become one another very quickly, and often that's the case, because what happens is that once a key support level, let's say this one here, this is an example of what could be a support area. Okay, let's highlight it in a different color. Let's make it yellow. And as you can see, this is a place where the price often goes through, sometimes breaking it. Here it found support somewhere else. And you can see already here, for example, that what's support here, and you can see how many times this price was tapped by these candles, tapped or breakthrough and close above, which is another way to see it. When it failed hard. Here it was holding also the 50, but that's a different idea. Once it broke through, it became resistance. And after it broke through again, it became support again here, and you can see it. Then it continued for a lot. Again, here you can see the same price level. And again, once it tapped it, it became basically trapped between view up and that price fell through, and then it fell by a lot. Okay, as I said, that's an area of price. It's rarely it is a specific price to the penny. It can happen. Usually it happens it can happen when the stock is approaching that level at a slower pace. Because what I like to imagine, just to give the idea of support and resistance, is like they are floors, no? And you have a weight in the price that's like going down. If you have a lot of orders to sell, it's easy that at some point you're going to break through the buyers at that price. And so you basically drop down quickly. And you may recover, but you go through it. Whereas if you approach the price very slowly, it's harder that you break through it. That's not always the case, but sometimes it happens. And I like to see it that way because it helps me mentally to imagine the idea of support and resistance. Okay? So that's what support and resistance are. This idea that I said about the floors gives you also an explanation why you usually refer to areas rather than price. For example, here you can see that it's more like an area between these two prices, like 169, 173, and this is also a narrow range. In some other cases, maybe much wider for choppy stocks, and you have the price going through this line very often, but sometimes he reclaims it, and it's once you get the eye tuned in for finding this kind of things, so this support and resistance lines, it's quite easy to spot them and identify of all of these wicks which is the one that matters the most. Okay, so let's go a bit further, and now let's try to understand how to identify those levels, because that's ultimately the only thing you need to make sure you do well when you're trying to look for support and resistance areas. And that's very important because then you're going to base your trade on those levels. And the most important of those levels maybe are going to be those that have been tapped several times, and maybe they have a daily relevance, weekly relevance. Sometimes it also depends on the kind of stock you're trading, what you're looking for. But the key idea is that if you're going to plan your trade based on that, at some point it really matters where you place that line. So it's very important to place it well. And there is no absolute truth. Many traders may place it in different places. And that's also, again, why the idea of a specific price doesn't really work. You have to think about it in terms of price areas. But if most of the traders are going to place that line where you place that line is going to be very important, because people are going to trade the stock or whatever it is based on that line. And so that's important. Now let's make a few examples and we'll try to go through them. When, as I showed in one other video, this on the bottom is the small cap gap scanner. Let's pretend that we're starting our day. So we're in pre-market, like here, okay? And we have the stock ramping up. The first thing we want to do is open the daily chart and try to spot the places where the stock moved and made a wick, for example, extended moves especially. And you usually you can go like this, for example. Now I'll explain why I placed also these ones. Okay, and that could be a starter. No, we're in this area, as we can see where the cross and the line, the dotted line is in between these two prices here. So you can see these are the levels from the daily. Some are respected, some other are not. I prefer to draw more rather than less, not because I consider them all valid, but because I want to see which ones are valid. So I want to see of all the levels that I draw, if there are some that are actually in place. And you can see that, for example, here we don't have the 173, we have the 177. 173, let's see if we can find it. 173, yeah, basically there is no such thing here. So it developed within the day itself, intraday. But we can look for it later. The first thing I usually try to do is to see where the price dips, and usually also if there is a higher volume. In this candle is not very high, but still higher, so it's important. And I try to look for those kind of things. We can try and make another example also on SPI, which is another stock that has made some pretty big moves in the past. So we're on the 1 minute, we can see it came higher during the after hours. So today it was here, so we can put the lines here. I use also these, like these two here, because well, this one actually taps the same price several times, so it may be an important level. Another thing that this instead is the tip of these two candles, 1 and 2, so again interesting. This one I tapped it, I made it and see how well it actually used it as resistance for the day. But just because it's the start of the move towards the other level. here you can see there is quite a lot of room between these two prices, and I want to know where there is the last price tip, no, the high of the candles. So I want to see when actually the move may start. Let's say this candle during the day actually broke through this level here. It can be possible that it would use it to propel a move higher. It's not necessarily the case, but that could be the case. And I prefer to make sure I have it on my chart. Then I can always see later on which levels are in play. And also one other thing that I think it's important, and that's why I prefer to put one more line rather than one less, is that if I see many lines stacked up, one after the other, as I sometimes call them the spaghetti chart, because they start to appear like this. So let's just pretend it's here now. You get filled with these yellow lines. I use yellow for daily levels, and so they start to look like a spaghetti, a bunch of spaghetti. So that's also because I'm Italian, but that's the idea. And if I see many of those lines, I start to believe that maybe it's hard that people are going to use them. No, so they are a bit intrusive in the chart when you look at the price action later, but they provide some insight. And you can see it here that, for example, this yellow line here was actually used as a resistance in this case for the move higher. It tapped it from this area here of 283, 279. It went up to 316, and then it came back down. Hold well the 20 EMA, this blue line, light blue line. Then it tapped it again, and as you can see here, let's zoom in. That level, once it was broken again, it became support. It never get back down from it, no? And actually it used that level to make a move higher. And it tapped it here again, another daily level. The higher the intensity of these moves and the closer are some of the levels, the easier it is that the stock will actually break through them, okay? And this, if you think about the mental aspect of trading, that makes perfect sense, because imagine you're setting a goal for your trade, no? Once you take an entry here. Clearly, if there are a lot of levels up here, first of all, you may not get that kind of entry, no? Because the risk to reward would not be in your favor, because the first resistance area is very close to your entry, and maybe the first support, like here or here, it's pretty far below. But let's imagine like you have it here, no, in the middle. Once you break through, if there is momentum and if the price is really getting quickly high, that level may turn into something that's going to be discarded, because it's too close to actually offer any resistance to such a big move, a strong move, and then the stock may try to reach the next one, which is not always the case. And you can see it here that yes, it made a move, but now I did from right here below, it broke through many levels, no, before stopping in this area. And this is clearly an area that, because of also the number of prices that are from the daily level that are all near here, no? And it never really made it to the next one, okay? I don't know why, for example, it stopped here. There may be some price somewhere where this basically stop it. Or it can be also sometimes a whole dollar, half dollar area, or something that other traders are looking for. And you can see that basically some of these levels held also later on. You can see this line here, and a bit also this one, but not that much in this occasion. This is not valid only for smaller price stocks. It can be also valid for higher price stocks, higher floats, higher caps. This is Tesla, for example, and you can see that in this case the pre-market high, which we may highlight in blue, for example, it served as a pretty clear resistance price for the stock when it moved from down here, which, as you can see, kinda is also a support level, and then it moved higher from here. Okay, this is also a very long cup and handle kind of setup. So we have a bottom, a valley, and a top and a smaller valley, and then it breaks. And there are many levels that sometimes can be drawn, and not all of them are horizontal. You may often see descending resistance or descending support, ascending resistance, ascending support lines. And let's take something like SPY, for example, on the daily chart, which is basically a pretty strong trending index in this case. And you can see if you try to match the very bottom of some wicks, look, you can try to use those points to try to align the highs and the lows of the candles and see where they actually end up. Like, for example, let's say this could be, for example, a sort of trend line. It's not the only one, there are several here. You can also take this one here and move it here. Sometimes you have to choose, like for example in this case, if we consider the wick of this candle here, let's zoom in a bit, but not too much. If we take the low of the candle, the wick, we can see it doesn't really tap much. But if we go and get the previous candle wick and the close of this candle here, look how pretty good it serves as a support line for SPY. And similarly, we can do the same kind of consideration for this, for example. You can see there are, like here, tapping 1, 2, 3, or we can maybe pick another place. It's really a trial and an error. It's not like a science, no? But if you take the most extremes candles up and down, and you try to make a line that goes through the chart, trying to see how many candles it taps or crosses, but only the wicks, the body of the candle stays below or above it, you can pretty much create a very strong resistance line in this case. Like here, it tapped almost quite precisely, and look here how well it basically got in this wedge that's creating, no? And sometimes you hear this word wedge, Wedge is actually a chart pattern that is created by ascending and ascending resistance and support. And it's something like this, for example. Why are these important? Because once you break those lines, that's where it's going to fuel the move in a stronger way. And we can see it here. It held this line and this high for a very long time. Here it tapped it, it came back up. And you can also notice that it broke this line when it began to tap it and cross it many times. Like here, it tapped once, it tapped twice. Here in this day, it tapped it maybe during the day, then it broke through, then it tried to recover. Then at this point, there was no more buyers here. This support was getting smaller and smaller and smaller and smaller each time this price was tapped. And the more frequent it happens, the higher are the chances that the price is going to fall. So it's a weird scenario where basically a support line is stronger the more time it is tapped in a given time frame. But if it gets tapped too many times in a very short time frame, like here, then it's easily going to break because there won't be enough buyers to hold this. Similar for resistance here, it tried to break through here. It tapped once, twice, three times, four times. It never made it, and so it came back. And as it came back, it seemed like it had lost the momentum to break through the upside of this wedge, and it started breaking on the downside. And you can see that this move here is basically the biggest one since this quite steep drop in this area, which made also the first occurrence of this candle breaking through this support line. And again, this is not science. Every rule can be set and broken every time. There is no real rule. It's only the validity of a trend line or support line or resistance line for that matter is based on the number of people that believe in that trend line, in that resistance line, in that support line. And the more it's believed to be valid, the more orders are going to be there sitting, or people will going to buy or sell in that area, looking for a target or for a possible place to buy. And that's going to be a self-fulfilling prophecy. Another thing that's going to be used sometimes, but only on bigger caps, not for small caps, is this kind of thing, which is the volume profile. Maybe we're going through this another time because the video is already pretty long. But this is also another element that you can use to identify key resistance and support areas. Just to briefly introduce this kind of indicator, that's the same of volume. So it's a volume indicator, but instead of the volume traded at a single time frame, this is the volume traded at the specific price. So the bigger the line here, the higher is the volume traded in this area. And this gives very well the idea of an area rather than a single price. You can see this is an area where there is a lot of price being a lot of volume being traded in this price area. Less here, much less here, a bit more here, and you can see how condensed are these candles. And again, that's not really a matter of a specific stock, commodity, it's valid also for cryptocurrencies. And if you train your eye, you're going to start seeing, like here, resistance, a support line that become resistance. Sometimes this is very choppy, and so it breaks through and comes back again often, but still valid. It can give you the basic prices onto which you can base your trade. So it's very important to learn how to identify them. And with that said, I hope you enjoyed the video, and if you have any questions of any kind, feel free to add them in the comments below. I try to answer every single one of you. That's it. See you and bye bye.